Okay, assholes. So you want to be an entrepreneur. Well, you may have had some textbook learning and stuff, and may have taken an MBA at Harvard and all that sort of thing. But oftentimes, what is missing for this entrepreneur stuff is what I'm going to give you in this thing, and how to make the deal, which is the most important part of it once it's structured like. When you go to the Shark Tank, that ain't a deal. That's a joke, that show. That's what I'm going to talk to you about. In the Shark Tank, contestants present an opportunity to invest. And so much money, that's what they're looking for, in their company, with their name and all that, they're so proud of it. And you're going to own some percentage of the company. That's followed by the sharks trying to extract the critical information that you should have provided them, but you didn't think it was important, showing your naivete. How much is sold, where it's sold, that sort of thing. You can read it. Then there's lots of banter and bargaining on the dollars and the percentage, as if it matters. And the TV show is, of course, I've concluded, is made by assholes, with assholes as contestants, and for audiences of assholes. Now, that's pretty harsh, but I'm going to show you, when you finish this video here, you'll believe what I'm saying, and you'll be a lot better off in terms of how to make a deal, in terms of structuring a deal, and actually, presumably, then get some funding. Okay? What happens in a real thing when you're dealing with real venture capital? It's going to put out real money, not just some kind of entertainment exercise. You present the opportunity, and you ask for so much money. And you tell them you're going to get a return on your investment, what you're putting in, of 10 to 1 in about 3 years' time. The name of the company and the percent of ownership are superfluous. Owning 33% of a bankrupt company is not a better deal if you own 45% of it. So it doesn't matter. You've got to give the critical information, and by doing so, you show that you understand what the critical information is, and then you establish your credibility. Probably if any serious VC has read or at least glanced at a business plan. So you don't waste his time and your time. They might not be interested in investing in the particular company type. They're interested in investing in children's toys, not sex toys. They know something about children's toys and sex toys, but they only invest in children's toys. I mean, this is reality. So, how do you structure the deal? And your job, of course, is to convince me to invest, or convince a venture capitalist to invest. So you got to answer the questions before I ask them, so you understand the business. That's not what happens in school. The instructor leads you through the business discussion. When you turn in your papers, they should have said this, you should have done that. Of course, they probably have never actually had to put together a deal, so it's what advice you're getting from them is questionable. So what does the deal consist of? The return on investment, as I mentioned, probably 10 to 1 with low risk. You can play the horses, but that's high risk. How much money are you looking for? The VC may be at the moment committed, even though he's interested in the product and all the rest of it. He can't come up with that much money. And how long and how am I going to get the return on investment? So about 3 years. And what is the equity do I get from the money? Now, if I'm a 1 or 2% kind of person, I'm probably not interested. 20, 25%, maybe I'm interested. But there may be another investor, maybe another 10% or so. But that's okay. The point is that I'm not one in a crowd. Okay? The product almost really doesn't matter too much. If you've done the market research and you've shown that people will buy it, and then you have some idea of the demand because of the size of the target market. You can get that from consensus. Women between the ages of 25 and 30, you can find that out. What is an entrepreneur? Well, he's a risk taker, but they've got experience and education, and you're trustworthy. Now that means if there are questions, you answer them directly, and you don't give up, set up something and then walk around and eventually hoping that the investor is going to forget what the question was. You won't forget. And but the biggest kind of character trait that people are looking for is your resourcefulness, because things are going to go wrong in this business, and they want to know, can you work around it without them having to hold your hand every day as this work you through the particular problem. Sometimes it can be helpful, so don't dismiss it. That can be very helpful, but the point is they're looking for you to be able to handle this, and that comes into the experience piece. The financials, you got to show the viability of the startup. The cash flow, how much, when do I give you the money, what happens to it, how fast does it go away, through the valley of death, VOD, and then what's the profitability at the end of 3 years. So that can all be covered by a P&L statement, and that's on the basis of that, we'll be talking about what the deal is worth. And a balance sheet, you might want to do it, but you're not really going to have any capital tied up in anything. And so it's really not going to be necessary, because everything is going to be contract manufactured. So we start here. The investment opportunity, that's what he wants, 10 to 1 on return on investment. That's what his investment. So how much money are you asking for? Let's go the other way. Imagine 3 years from now that there's a stable, profitable company. Okay? Then, what's the value of that company? Well, it's equal to the price to earnings ratio times the earnings. And if we say the price of earnings ratio is 10, and you can pick one, whatever the industry is, but this is just, I'll be using this throughout this little talk here. So that's what it is. So now the investor value has got to be equal to this 10 times that in terms of times his percent of ownership. And so that's what this is over here, and you can read through this thing. And for a 50% ownership in the company, that's what he'd be making. 50% times the earnings, in this case, because the 1/10 of the 10 factor here drops up. If he's going to pay for 50% of the company, he wants to pay 1/10 of what the company actually ends up with, so there's the 10th times that, and that's what it is. And does that investment that I have to put in, because that's all of us, all the investors, whatever they're putting in, does that equal to an itemized cost of the startup? So again, we'll go over this a little bit further, but that's what it amounts to. Now, what happens? You put the money into the business, goes into a checking account, and then the money goes away as you do the design and set up the business and that sort of thing. And eventually, you get to the lowest point here, and hopefully that you still have some sort of money left when sales start back, when money starts coming in. This is all going out. If you look at it in terms of cash flow, this is all the money is going out over this time. Of course, it's jagged. It's not a smooth curve, but if you did this by week, that much money, that much. So you're spending really heavily at the beginning. Then the business gets ready to start launching the product. You launch the product, and some money starts coming in, and eventually, if it's successful, reach the point of break even, where the money going out is equal to the money coming in. If you don't pay this back, that doesn't matter. That's not what break even is. It's just the difference in these two cash flows. Okay? So, you might think of this break-even point as some kind of a pivot. It's an important piece between when you're losing money and when you start making money. And you might consider it also as sort of a test marketing phase, because that's about all you've done. You've had this hypothesis of that I can make this product and sell it and make a profit, and you've quantified that hypothesis in your business plan, and then you put it to the test and you get through the valley of death. Now, once you get through there, of course, there's much less risk involved, but you still got to grow the business and manage it, so that by no means is it easy street at that point. However, if there's any subsequent investment, you can offer that at a much lower risk, because the business is already going. There's an important distinction here, because when you go out and you do your market research, that's going to be the price that people are going to pay, and that's what will be in the store. And the store revenue, of course, is what the sales price, that's what they pay, times the volume of the products, of your product. But importance to you is the company revenue, which is the sales price times the volume, your sales price, your company sales price. And that typically is about half of what the public price is, about 100% markup. Now, what you can look at in terms of, this is sort of based on a profit and loss statement. So once you have the revenue, an estimate, then what's the cost of goods sold? And that then can be the target cost of the good, for one unit. And so if the store is selling it for $20, you're going to sell it for $10. Can you make it for $5? Can you make the product for $5? That's what that line means. And that's a test. You've got to go and see whether that's the case by looking at the bottom-up cost of the bill of materials. This next one here, the cost to sell the goods, is my category, which clumps together a lot of things: the administration, the overhead costs, and the profit. If you don't make a profit, you're not going to sell the goods. Okay? But at the break-even point, there is no profit. So it's not actually a part of that. It is part of it, but the profit is zero. So what is the cost to sell goods? It's the advertising, it's your salaries, and as I said, the company doesn't survive unless you make a profit. So it's actually a cost to sell the goods if you just look at it impersonally at the business. Okay? So what you've got to do is you've got to put together a business feasibility analysis and an investment analysis. So after 3 years, let's just assume you've achieved a stable operation, but potential for growth in the following year. And you prepare a P&L, estimated P&L statement. So you have the cost of goods sold, top down from the market sales price, as I said, that becomes the target. And then you can do a bottom up. And that means you've got to look at all the parts, how much does it cost to put them, the materials, labor, manufacturing, everything. What does it put them together? And that's the target cost. So does that equal the target cost? That's the real question. Coming from the top down versus the bottom up. So there's a check. And it would be useful for a VC to see that. Cost to sell the goods. You can take it down. It's about, in this case, we're assuming 50%, so 50% of the thing is that. And so then, what's the bottom up sum of all those costs that I mentioned in the previous slide? Are they equal? Coming down and up again. Now you have to look at what the investor's going to do. The cost of goods sold, that's equal to the revenue without the 10% profit, as I said. This is just the business at the break-even point, and then later I'll give you the stuff for when there's a profit. You can estimate the company worth. If you had 10% in the company, you could from a top-down point of view, that'd be your target investment. And then the bottom up is the sum of the value of death costs. Does that equal? Do those things equal, as I said? Now, this one, you actually have the 10% in there, in the cost of goods sold. But what we're going to do next is look at what does it take to have these are just some other comments. You should have a safety reserve, as I mentioned before, so you have some survival time. There might be a delay in sales, independent of any poor management at all. Governance, how much is the investor involved in various decisions? And how much communication do you have to have, all of those sorts of things, and that'll vary. You'll notice the Shark Tanks don't seem to worry too much about that. They think they're just going to buy it and then it's going to make money like a golden goose. You want to have few investors so you can control them. You have 20 people, there'll be them plus the 2 or 3 of you as the founders, and then it'll be, that's 23 plus, then there'll be a 24th opinion on some issue. Equity of the estate of all of the investors probably shouldn't be any greater than 35% initially. You can expand and still sell some equity and still maintain control, 51% of control. And you certainly want to have a whole bunch of this or some sort of contractual agreement. Then you need to talk about the exit strategy and the options. Again, sharks, they never seem to concern themselves with that. At the end of 3 years, you're going to be able to, will the company buy their stock back? Can they sell their stock? There's an endless number of issues like that. And again, you can offer a few, and then the investors will have some suggestions about what they want. And that's part of the negotiation, and all part of the deal, but it's the negotiation part. So, what does it take to get to the break-even volume of sales? And I went down through that with the cost of goods being 50% and the cost to sell goods at the break-even also being 50% of the revenue at break-even. And again, I won't bore you through that. You can look that over yourself. And but it ends out that the annual sales volume is equal to the cost to sell the goods divided by your unit price. Okay? When you walk down through all of that sort of thing. And so the above shows how all these various things combine, and you can look at the top-down sets the target values for the various costs and the volume if there's a 10% profit. And that's the next piece. So, you've got the value of the volume at this point. You want to know, what does it take for 15% of the revenue? Okay? And what sales volume? So that's the difference between these total costs and that, the 15% revenue. And again, I'm not going to walk through all of this, but you end up with the sales volume divided by the break-even volume is equal to, for this 10% profit ratio, is equal to 140%. So you got to sell 40% more goods, or 50% more. Now this will vary depending upon the various ratios of the cost of goods sold and the cost to sell the goods. Okay, so what's my advice? You need discipline, 24/7. It would be useful to look up the Boy Scout characteristics. I didn't include them because you can look them up on the internet. There's a dozen of them. One that's not in there is resourcefulness. And that's, as I said, your ability to work around adversity and that sort of thing so that you don't have to have your hand held. You're going to be doing contract manufacturing. That's a guarantee. You might read through the poem If by Kipling. If you can keep your head while all about you are losing theirs, you'll be a man. And that's what it's going to take. You've got to be cool. Balance your life. You don't get overwhelmed. Just be cool, work through it, and be resourceful. You've got to live like an undergraduate. And in fact, by the fact that you're foregoing your professional salary, that's your in-kind contribution or investment to the business for the 3 years. So, good luck, and hope you're successful. Certainly if you went to the Shark Tank, you'd see exactly how childish and amateurish that thing is. But the real world, or the real money, with real venture capitalists, they're going to want to have this and more. But this is a good start, and you can follow your lead from there. Okay? Thanks. Bye.